If you are using the Trading 212 app and are curious about how to buy and sell stuff with the app, more specifically if you are curious about these additional options that we have here, then this is the tutorial for you. So let's get straight into it. Of course, the first thing that you do on Trading 212 is to pick a stock that you want to buy in. As this video is not financial advice, I'm going to go into a random company, and for that I have selected BP. Now, when you go into a certain company, you have two options, of course, to buy the stock and to sell the stock. So in this video, we're going to be talking about how to do that, but more specifically, the advanced options. Now, if you haven't already signed up to Trading 212, you can use my link in the description. And when you sign up and top up your account with £1, you can get a free fractional share worth up to £100. Alternatively, if you've signed up less than 10 days ago and haven't received a free share, hit the 3 horizontal line menu over here, scroll all the way down until you see the use promo code section and enter the code JUBAIR and you should receive a free share. So when it comes to buying on Trading 212, there are a few options. So when you click the buy button here, the first one is by default the market order. As you can see right now, the market is open, meaning that the price of BP is going to go up and down throughout the day. This is very, very normal. As you can see throughout the day, the price has gone up and down, and that's just how the stock market works. Essentially, the stock market is a marketplace where people can trade their shares of a company, for example, BP. When the demand is high, the share price is high. When the demand is lower, the share price is lower. But there are other factors that really determine what price you pay for the actual shares you get. As you can see, this number is changing all the time. But anyway, let's say I wanted to buy BP. Currently, press buy. Now in it, I can place a market order. I can choose the amount of shares that I want or the value, which means the amount that I want to spend to buy BP, for example. So I can go into value. Let's say we wanted to spend £100 and we wanted to invest £100 into BP. Currently, that will give me around 25.72 shares. Share price currently here at 386 pence. That will change all the time. So if I did want to buy that, I press review order here, and you can see that the order type is market type, which means currently when I place an order, it will execute almost immediately at the market. And then Trading 212, essentially the stockbroker, will find you a buyer, so someone that can sell you the shares of BP at that specific time. It might not just be one person. You know, the stock market is very complicated, but it's Trading 212 or your stockbroker's job to find you the shares that you are looking for, essentially. So that's very simple. You know, you can even sell at the market. For example, I actually do have shares in BP. You can see I have 21.06 shares. So this is actually a good example. So what I can do is go into sell, and currently the first one by default is market order. And if I review order, you can see if I wanted to right now, I could sell, and currently my shares will be worth £81.58, but I do not want to do that now. As you can see, if I go down, overall in my portfolio, I am down in this company by 26.3%. So I'll actually be making a loss overall if I wanted to sell it at market. Therefore, as an investor, there are tools that we can use both in selling and buying that will help us limit our losses or increase our potential bottom line. So if I go into sell, for example, I am not going to sell at the market order. What I can do is to place a limit sell order that should, in theory anyway, allow me to select a minimum price that I'm willing to pay for. For example, I want to sell my BP shares when they hit 500 pence, currently at 386 pence. As you can see, that is 113 pence higher than the current price. But anyway, if I wanted to do that, you know, I have two options. One is by the end of the day, if it doesn't hit that price, then it will actually cancel this order. The other is never, which means that this limit sell is not going to expire and it's going to stay active until it hits 500 pence, if it ever does that. Now I can press review order here. So as you can see, this type of sell is a limit sell, which means if the price hits 500 pence, which there is no guarantee that it will ever hit, then Trading 212 will try to execute at 500 pence, and I should receive around £105.33. Now, like I said before, the stock market is a very complex thing. There are a lot of variables, and 500 pence that you put in here is never guaranteed. For example, today, if I put a limit sell at 389 pence, as you can see here, it was 389 pence. There is still no guarantee that my order will be executed at 389 289 pence. Just because it shows that price on the graph doesn't mean that there are enough people selling at that point for your order to be executed. So your stockbroker will actually be in a frenzy to connect people with each other that are buying and selling. So yeah, it doesn't always act like that. Now, when it comes to limit buys, this is basically the opposite. Let's say I want to buy BP shares only when the price is lower. Let's say I want to buy, one share in BP when the price hits 250 pence, because I think that is an absolute bargain. If it were to execute at that, then I'd be very happy to buy BP, because otherwise I'm not very happy. I've done my valuation on this company and I'm only comfortable in buying shares if it was 250 pence. Then I put the maximum amount that I'm willing to pay for per share, and then review order. You can see this is a limit buy at a maximum of 250 pence or £2.50, and if it hits this, trading 212 will try to execute. Again, there is no guarantee that if it hits £2.50 for a brief moment that you will ever see your execution go through. There are a lot of variables that would determine if you got that price. However, let's say the price dropped of BP to £2.33, so 233 pence, and it stayed there for a whole month, then it is likely that your order will be executed at £2.50, because with a limit buy, from my experience, you get that price. Even if the market drops a considerable amount more, this is what you're going to get, which is one of the downfalls of a limit buy or sell, is that if the markets change even further than what you're expecting, then you can be locked out of the market, if that makes sense. So the next type of limit order is the stop limit order, and essentially this is for both sell and buy. For example, if I wanted to go into buy and I wanted to place a stop buy, essentially with a stop buy you can set a price that is above the current market price. So once it hits that price, let's say for example I want to place a stop buy when the price hits 400 pence, I can put in the number of shares that I want, and then for example 400 pence, and then if the price goes above 400 pence, then it will convert my order into a market order, meaning that it will try to execute it. Now, a lot of you might be thinking, why on earth would you do this? Why would you purposely want to buy a share of a company that's higher than the actual market price? Makes absolutely no sense. And for the majority of people, especially my audience who are long-term investors, this makes no sense. This is also why I don't normally cover this, as these tools are more specifically useful for traders who want to trade resistance lines. Essentially, when a company becomes very popular, that's when they want to start trading. So for this reason, they might want to use a stop buy. It makes no sense for anyone looking to invest for the long term. Now, if you go into the sell menu, you can also see there is a stop sell as well. Here you will set a price below the current price that will convert your order into a market order. Again, why would you want to lose money for no reason? It makes no sense for the average person. I wouldn't recommend it for most people. Now, the last type of limit order will be your stop limit order. Again, this is more specifically aimed for traders in my opinion. This is basically when you really want to secure a certain price. So first of all, you would choose the number of shares that you want. Let's say for example, you just want one share. Now here you select a price above the current price that will convert it into a limit order. For example, if I wanted 400 pence for BP, again, it makes no sense for the normal person. It is above the current price and that will convert it into a limit order. And then you choose the maximum amount you are willing to pay for that. So let's say 401. Again, for the majority of people, I would not recommend using these last two options, stop and stop limit. If you do want to buy shares on Trading 212, you can always use the market. However, I personally refrain myself from using market order a lot of the times. Instead, I always use a limit order. Let's say, for example, I wanted to buy BP even today. I can select the number of shares I want, for example, 1. And then I can even put in the current price of 386 pence. And then I can even put in 48 as well. And then if I review order and then go through it, it will buy at that price. Typically speaking, there are risks in buying in the market because the market is so volatile. Even if I put in £1 here, there is no guarantee that I'm going to get 0.25 shares. The market can go up and down very quickly. This is most apparent when you enter the number of shares. You can see here £3.89. Just a second ago is £3.88. But if you are buying a bulk of shares, let's say 1,000 shares, that will be £3,884 at one point. And a second later, this could be £3,900. So if you do want to limit your losses, you can always press limit, and enter the price that you are willing to pay for. However, the downside of using a limit order is that sometimes you're going to have to wait for that price to be hit. And just because you have a limit order does not mean that your price will be executed if it does appear on the graph because the graph is not representative of the actual trading volume at any given time. I recommend anyone wanting to learn more about stop orders, limit orders, anything like that to go onto the Trading 212 website, and they have a very good article that explains everything. More importantly, they explain the pros and cons of stop orders, which are very important to read. For example, stop orders can be used for risk management purposes. For the average person though, I don't think you would want to look too much into these. Whenever you're paid, if you are a long-term investor, just buy the stock and don't worry about how much you're buying it for. But if you're really worried, you can actually use these tools, but they are more catered towards traders. Essentially, by setting a stop price, traders can make sure that their positions are automatically sold. So if you have a lot of holdings, doing a lot of trades, it can be a really useful tool to automate things. Also, as a trader, there is a lot of risk of sudden market downturns or upturns that can ruin your buy or sell limits. By using these features, you can essentially minimize your losses. For me, the best thing about these sell and buy limit orders is that, they are very flexible. I can place a limit buy or sell and then cancel it at any point and then reconfigure it at any point. So if the market conditions are changing, I can adapt to the market conditions. But again, for long-term investors, you probably are not going to be looking into doing trading or anything like that. Now, of course, as with anything, your capital is at risk when investing. But also, if you decide to trade, you must be aware of the risks that come with that. For example, there are some cons of stop orders. Like I said before, on a good day, the stock market is very volatile, but sometimes we experience even higher degrees of volatility. And in those cases, stop orders may execute in a way that you weren't actually hoping they would. Here, Trading 212 says in fast-moving markets where the prices fluctuate rapidly, your stop order could be executed at prices significantly lower than what you were expecting it to, causing losses for the trader. So that's something to bear in mind. Also, if you forget to cancel your limit buy or sell, then that could significantly impact you the next day when the market opens at a very different price to the market close. So here in the article, it explains about stop orders and price gaps, where basically stop orders can be affected by price gaps in the market. This is when a price gap occurs when there is a significant difference between the closing price of a security. By security, they mean stocks and shares, and the opening price of these securities are very different the next trading day. So make sure to check out some of my other videos, and I'll see you in the next video.